I do always like to start off the show with a rundown of kind of what we saw happening this week in the market, and there's a lot going on actually. So let's talk about that. All right. So first of all, this is kind of a longer term chart here. We got weekly data, so it's kind of smoothed out a little bit. You can see, the big pandemic drop that happened, big run up after that, and inflation was high. We dropped 28%. So we bottomed out here, on the run that we're on now, October 13th of 2022. All right. So bull markets are 3 to 5 years, depending on what time frame you're looking back, right? So we're
Mhm.
what 1 and 3/4 years into this, more or
Yeah.
less, something along that. So there's some room to run. I do believe that I think the shortest bull market was like a year and a half or something like that, or shorter, maybe not shortest, but uh, I think we have room to run here. However, if you look at the amazing amount of return that has come from October 27th of last year to basically today, we've had only one interruption. 5% drop in April this year, and it looks like we're heading for another interruption
Yeah.
as we speak. Because this week, of course, we've had a 1.4% drop, followed by a 0.8% drop, and we were around 0.8% when the show started. Drop for today, also, and so the first half of July is the best half a month historically, going all the way back to 1928 and using that data. And the second half is much more, of a mundane, average rate of return
Yeah. A
for.
pretty flat period of
Yeah, and
time.
matter of fact, the data that they looked at going back to 1928, they mentioned in that Bloomberg article that the softness started on the 17th. Okay, so that 17th was the 1.4% down day, and so we've been coming down every day since that point in time, and we have a ways to go before we're going to see a reversal trend. But what we are seeing right now, I think, is just the first half of the month, it was 11 trading days. We were up on 10 of them, right?
Hmm.
So you're not going to hold those kind of gains that often. And we are now heading into a softer time of the year, right? So there's some things going on as far as that goes. Fundamentally, not much has changed, right? There was some talk that kind of kicked off the downturn on the 17th from both sides, actually. On one side, the White House came out and said they were going to crack down more on sales of chips to China.
Yeah. Basically, anything with U.S. technology could
Yeah.
be considered put under restriction.
Yeah, and then at that same day, actually, Trump talked about whether or not they would support Taiwan if China invaded, and he was waffling on it a little bit, and saying that they might have to pay for their own security type of thing, and whatnot. So both of those pieces that come together start this downturn, but I still think you can attach news to almost anything that's going on, right? It could have been still going up even with those comments, and nobody would have said anything about those comments. I think this is much more so a situation where we stretch the rubber band so much to the upside, and we're going to get some pullback. I look at these things as positives. All downturns are positives until they actually go far enough to change the primary direction. Because if you look at last year, we had a 10% drop from July 31st to October 27th, and yet we still ended up with a 25% gain for the year. Sometimes you need to come down to stimulate that buying, right? And so, people aren't interested at that higher price at this time and leaves just sellers, and you start to come down. So if you look at the primary trend, one of the things, we look at lots of things, and I try to keep this on the show fairly simple. There is more behind the scenes that happens, but this is a good one to watch, and everybody can do this. You look at the lows on the way up,
Hmm.
right? And so what? There's 5 arrows there. Every low is higher than the last one. So that's still maintaining the primary trend. Now, in order to make the primary trend reverse to downside, right, you have to kind of get below the last low, which is that last arrow there. So basically, draw the line there. If the market falls below that, we are now in a primary downtrend. If you look at the numbers behind this, it is 49.67 is that low point, and we got to 56.67, exactly 700 points was the closing high so far. So it's a 12% drop, right? I'd be a little surprised to see a 12% drop here. There seems to be still enough power in this momentum upward. Anything can happen. Weird things happen all the time. Um, but that's what we'll be watching for. So until you get to that point where you're cracking through that low, this downturn is just a secondary minor move to the downside,
Hmm.
right? Those are good things in a hot market because, again, if we want to get to the next all-time high close and really make it run again, might take till November for the
Yeah.
election to really see that. But nonetheless, that consolidation period and that drop that comes down will be, what kind of stimulates the buying ultimately. And then one of the other things is that you get some support. So one of the problems we have since October, we basically haven't spent any time at any price for very long. There's some support for that retracement that happened in April, right, and back up in May. And so, we could bounce off of that. I wouldn't be surprised. But the problem with going up so fast like we have so far, just recently, is there's no support. We didn't spend any time there. So
Hmm.
I wouldn't be surprised to see it come down to at least the top of that April move.
So like that 5200 area.
Yes, yeah, exactly. That wouldn't surprise me at all. Matter of fact, I'd be surprised if it didn't get there. Just because again, we're in a selling mode now. There's enough momentum happening that you'll get down to some price that hopefully people want. One of the other things we look at now, this is daily data, so you can see it's a little bit more jagged, but the blue line there is the 200-day moving average. So every point on that line looks at the past 200 days and averages it out and puts the point. And the yellow or gold line there is a 50-day moving average. And so, you're looking for that crossover. They call it the death cross for a reason, where the 50 is coming down. You can look back there at the beginning of 2022, and that was the last death cross we had. The other way where it comes up under it was February of last year. That's called the golden cross, right? So they're really far apart right now.
Yeah.
And you can see last year, it dipped down, it got closer, with that 10% drop, but it never crossed through either. So if we look at last year's downturn, we never had a primary direction change based on the lows because we never got to a new low, a lower low, and then we never had a death cross either. So both of those. So those are, just we're going to have some roughness here, in my opinion. We're heading for a seasonal. And I'll show you. This is our primary trends piece. Uh, this is kind of interesting, right? We basically put a column on there when something changes. So on the 18th, yesterday, the hourly piece changed to red, which just means that the primary direction, if you look at the hourly component data. So in other words, you can look at the market by hour, by day, by week, by month, right? Now you can get by minute and all kinds of things, but by hour we've actually changed direction. So for us, that just means new money coming in. We're waiting. We're holding on to it
Yeah.
because we'd like to see that reverse before we start to throw that new money in case this turns into a bigger downturn. So there's always that possibility. So we'll wait for a little while. If we look at kind of the breadth of all of these other ETFs, that represent different segments of the market and what have you, all still the same as they were on June 3rd, which is all green except for transportation, right? Which is still not. It made a run at trying to get to a new high to turn that back to green, but it hasn't happened. So anyway, that's what's going on. But on a seasonal basis, we shared this chart the last show. I apologize because some of the numbers are pretty small. But what this is just showing is on average, what percentage of the time was the month positive, right? And so July, 75% positive. And then there's a small number down by the axis that says 2.4%
Yeah. So we
average return.
averaged 2.4%
Right.
return per the month.
Right. And so, but if you look at, here's August, September, October, all of them have a 60%, chance of having a positive month, or historically anyway. But the returns are, 0.1% for August, so basically nothing on average. Negative 0.6 in September.
Yeah. September's the only negative month out there.
Yeah, that's right. It's
Or no, actually June is.
June has a small
Yeah.
negative too, but it's the weakest month. A lot of people talk about October clients because they remember the bigger crashes like the '87 crash and stuff. But on average, October is actually out of the 3 months is best. It's got a 1% average return. So we have this seasonal situation. We're also in a presidential election year. And so in my experience, presidential election years, you get at least a lot of volatility in September and October. And usually volume kind of dies down some. I think the markets are somewhat concerned about who's going to win, but more concerned about unknowns than anything else. So, once the election is over, you get November, which is a great month. It's 80% time. It's up, and it's up 2.5%. That's the highest month. So November is the best. So and that's true of elections also. You'll notice it doesn't matter who wins on and what happens. The market has gone up for a really long time, as far as I can remember, in November after a presidential election's over. So we kind of have the seasonal aspect of what's coming here. We've already had a big run up. We've got a falling market for the last 3 days. I think we continue to have some volatility. I I don't think we'll change primary direction. I don't think we'd get that full 12% down. That would be my guess anyway, even with the election coming, because there is a lot of things going on. Now, there is one part of this that could move this the other way to make it a stronger, September, for example, and that is this rate cut. And so right now, the market is expecting almost 100% chance of a rate cut in September. Of course, if it doesn't happen, that expectation would be, detrimental. And so, yeah, we have seasonality. Yes, we have, presidential election year seasonality combined together to probably make things soft. Could be offset some by, the decrease in rates. I have to wonder how much of that's already baked in, to the situation. Do we get a big pop? I mean, we've been talking about cutting rates for a long time. The last rate increase was in July, right? Yeah. So a year. And so I think it's a very, interesting market to be involved with. But it's, the momentum is already there. If you look at the numbers, I mean, if you look at the last, times that we've had a 15% or close to 15% return in the first half, we've averaged 10% in the second half, right? I think we're gonna get that. I wouldn't be surprised. However, just like last year, you can still have a pretty good sized downturn in the middle of that. And some ways, again, I think you need to have that kind of downturn. If you don't, you're going to end up with a market that is so stretched out and is so thin, and earnings are, PE ratios are really out of whack. That's how you can get a bigger downturn, turn into a bear market, which is considered 20% drop or more, right? I like these little, let's take some steam off here. We've had a great run even since the, I think 19th of April was the low point for that little April run to the downside. And so we've been basically going up almost every day, since April. So, hey, let's have a little steam off, not enough to maybe change direction, but 5%, 10% range, whatever it might be. Let's waffle around for a while, build a base, because I think that's important. And then if you could design it as an ideal, you would jump out of that base, and now you have support below that, and you've got a healthier market run that happens. And so, the stock market is a representation of human emotion. It doesn't go in a straight line because of that. It generally goes to the extremes to a large degree. And so you're going to stretch it out too far, and then everybody realizes that, and then it falls back down, and that's how it works. And understanding it and dealing with it and being patient with it is how you get paid more, right? Because you go to the bank, you put the money in CD, pays pretty decent right now, but you're not making the kind of money that we're making in the stock market over a long period of time. And so you have to be able to kind of understand the market. That's what this show is about. It's why I put out the video every single day, just trying to explain kind of what's happening to the market itself. So anyway, that's our summary for this week. Really glad that you could join us. Looking forward to doing it again next week.